person more powerful than the President of the United States is the Chairman of the Federal Reserve, who runs the central bank behind the world's reserve currency, the king dollar. This is especially so when the Federal Reserve is raising interest rates. We're barely 3 months into the new Fed hiking cycle, and the global financial market is already shaking in its boots. How long will the Fed hiking cycle last? How high will interest rates go? Will the US and global economy go into a recession as a result? What does it mean for stocks and bonds? Hello, I'm David Wu, a former Wall Street investment strategist with a 20-year track record of making actionable predictions about major global change. Welcome to The Money Game, where I take on groupthink, propaganda, and conspiracy theories in my critical analysis of markets, economics, and politics. But before we begin, please hit subscribe so that you will be notified when a new video comes out. So how long will the current Fed hiking cycle last? Over the past 70 years, there have been 12 distinct periods during which the Fed was raising interest rates. The length of these periods vary greatly. For example, the 1999-2000 hiking cycle lasted just a year. In contrast, the 1961-1966 tightening period lasted 5 years. The median length of the hiking cycle over the past 12 episodes is 24 months. One very important factor determining the length of the hiking cycle is the speed of the tightening. As you can see on this chart, the length and the speed of tightening have been inversely correlated over the past 70 years. Generally, the faster the pace of the rate hike, the shorter the duration of the hiking cycle. With the Fed having already raised 150 basis points since March, this may prove to be one of the fastest rate hiking cycles yet. Naturally, following from the above chart, the consensus is that this will be a relatively short hiking cycle. But don't hold your breath yet. What about the magnitude of the interest rate hikes? History is not too helpful in this regard, as the range of cumulative interest rate increases is very wide, as you can see here on this chart. The median over the past 70 years is 3.5 percentage points. Interestingly, this also happens to be what the market is pricing right now for the present hiking cycle. The grim reality is, as incredible as it may be, inflation is running at a 50-year high. Moreover, unemployment rate is at a 50-year low. Given where inflation is and where the unemployment rate is, the so-called Taylor rule that gives us a benchmark for policy interest rates should be, indicates the Fed funds rate should be at 10%. Indeed, never over the past 7 years has the deviation of the actual Fed funds rate from the one implied from the Taylor rule has been greater than now, as you can see on this chart. History gives us more than a hint about where rates are likely headed. At the end of the past 12 Fed hiking cycles, the Fed funds rate will on average 2 percentage points higher than inflation. This means that if inflation is at 8% at the end of the Fed hiking cycle, Fed funds rate could be at 10%. However, if inflation, let's say, goes down to 4%, Fed funds rates still have to basically go up to 6%. But could interest rates really get up to 6%, let alone 10%? You're right to be skeptical. After all, past interest rate cycles were littered with economic casualties that threatened to take down everyone with them. For example, the savings and loans crisis of 1980, the collapse of the Continental Illinois in 1984, the largest ever bank failure in the United States, the bankruptcy of Orange County in 1994, the Argentina debt crisis in 2001, the collapse of Lehman Brothers in 2008. Don't get me wrong, the interest rate increase by the Fed was not the cause of all these crises. However, there is no doubt that it was the catalyst that brought on these crises. When we consider the question of how high the Fed funds rate will reach in the cycle, we need to ask ourselves whether there are similar skeletons in the closet that could come out suddenly, derailing the tightening cycle. Financial leverage was at the root of most of these crises. The good news today is that the US economy, at least the private sector, has been deleveraging for most of the past 10 years. For instance, household debt as a share of disposable income is now at a 2-decade low. Corporate leverage is near the lowest levels in 70 years. Meanwhile, American banks have become much better capitalized over the past 10 years. What all this means is the balance sheet of the system is stronger than ever. The first implication of this is that the system should be able to withstand higher interest rates. The second implication that follows is that interest rates could potentially reach higher ground than in the past. I guess you don't like what I'm saying. You want to know what could bring about the end of the Fed hiking cycle. One thing that could do the trick is, of course, a recession. The Fed has seldom kept on raising interest rates when the economy goes into a recession. Indeed, only on 2 occasions did the Fed go on raising interest rates when the economy was already in a recession. That was in 1975 and 1981. However, even on these 2 occasions, the Fed did not go on raising rates once people started losing their jobs. The Fed has a dual mandate: price stability and full employment. History suggests that the Fed's resolve in pursuing price stability tends to get weaker once it comes at the expense of full employment. On most occasions, almost as soon as unemployment rates started to go up, the Fed ended its hiking cycle. Based on this, it may be reasonable to assume that the most the Fed will be able to tolerate is a 1 percentage point increase in the unemployment rate, meaning it will stop raising rates before the unemployment rate rises to 4.6% from the present 3.6%. This Fed hiking cycle is unique in many ways. 1, the Fed is starting to raise interest rates very late in the business cycle. The Fed has never been more behind the curve than at any time in 70 years. 2, the gap between where interest rates should be and where they are right now has never been wider as now. 3, the balance sheet of the private sector is at its strongest in decades. This should allow the Fed to be aggressive as it plays catch-up. 4, because the Fed is starting so late, it is very unlikely that the economy will be able to avoid a recession. What does this mean for financial markets? All else being equal, the path of least resistance remains higher interest rates and higher bond yields, at least until the data suggests that a major slowdown is underway. As bond yields go up, stocks will get derated. As this chart makes clear, higher bond yields means investors will require higher earning yields for holding stocks. Stocks might have already fallen a lot, but the sell-off is very unlikely to be over. The time will come for bottom fishing, but it is not now. If you got something out of this program, I would appreciate that you hit like and subscribe to my free YouTube channel. If you want to learn more about my investment strategy, please come visit us at davidwuunbound.com. Thank you for listening.